Welcome back, everyone. I welcome you all to our much awaited inaugural panel to talk about institutional investors' appetite for Indian commercial real estate, whether it's waxing or waning. I'm very pleased to welcome our moderator, Mr. Kailash Babar, who's the senior assistant editor at Economic Times. Kailash, can we have you on the screen, please? Kailash is the leading real estate editor, a seasoned writer, and much sought after by everyone. Kailash is the only Indian journalist whose story was tweeted by the US president. I mean, I was not aware of this, Kailash. Welcome aboard.
Thanks, Nikhil. Thanks.
We are very happy to have with us our esteemed panelists, Mr. Chanakya Chakravarti, who's the managing director at Ivanhoé, Cambridge. Ivanhoé is the real estate arm of the largest Canadian pension fund, CDPQ. Chan, can we have you online? Chan is a seasoned manager and investor with over 3 decades of experience, including over 22 years with senior executive roles in investment management, development, general management, and strategic advisory. Welcome, Chan. Up next, we have Mr. Vinamra Srivastava, who's the CEO of Business Parks at CapitaLand India, one of the Asia's largest diversified real estate groups. Vinamra oversees investments, development, operations, asset management, and strategic planning for CapitaLand Group's business parks in India. Welcome, Vinamra. We also have with us Mr. Ashish Singh, who's the partner real estate at Actis. Ashish has been working in Indian real estate market for around 20 years now and was a founding member for Actis Asia Real Estate and leads the real estate investing in India. He's responsible for setting up of marquee platforms for Actis Asia Real Estate in India with most reputable partners in the country, including Tata Realty, Mahindra Life Spaces, and Shapoorji Pallonji. As we await for our last panelist to join, Raj, I would request Kailash to perhaps start moderating, and once Raj is there, we'll ask him to join in.
Good morning, everyone. The ongoing pandemic has been impacting our lives and will continue to change the way we live, work, and play. Indian commercial real estate, in particular, has witnessed a variety of challenges since the outbreak started in the early part of this year. Global institutional investments in the Indian office markets have remained strong for more than a decade now. In 2019, they invested over $5 billion in Indian real estate, and most of it was deployed in office properties. Although the pandemic has or may alter investment philosophies, the investors are likely to continue to repose faith in Indian real estate, given the high value and growth metrics in the market that the market offers. There have been talks about the emergence of work from home model impacting the demand for office space, which has remained strong so far. And exactly when the skepticism was high, we saw Brookfield Asset Management striking a $2 billion deal for RNZ's 12.5 million square feet commercial portfolio. Right after that came Blackstone's $1.3 billion deal for prestige commercial assets. These deals by global investors are in contrast with popular opinion, perception, and view on the ground, baffling for all of us. I am joined by a distinguished panel of experts to discuss and decipher this for us today. So let's hear it from them. I'll come to you, Chanakya, first. Where do you think Indian commercial real estate fits in the global scheme of demand for grade A office spaces in times to come? And where do you think various trends in office demand puts us in the office cycle currently?
Thanks, Kailash. Thank you, APREA and NAREDCO, for the opportunity to participate. I just wanted to start by referencing the headline to this session: Is Indian real estate waxing or waning? I would say that, I'm reminded of the adage, it's never as good as they say it is, and never as bad as they make it out to be. So Indian real estate is a little bit like that. And Indian commercial real estate, or specifically India office, I would say the market has been continuously formalizing over the last 2 or 3 years. We've had some pretty interesting changes that took place even prior to the pandemic setting in. And with the influx of global capital, I think it would be safe to say that even if the market didn't want to change, it is being forced to change in a good way. I don't mean it in a negative light at all. And with that, what we're seeing happening is a constant churn and adjustment to global institutional investor expectations, global occupier expectations. And now with a, you referenced two significant transactions in the last 2 or 3 months. And that's, I would say, is a sign of the confidence that global investors continue to repose in Indian office segment, primarily because of the predictability of demand, and the demand that is not as commoditized as was seen to be the case, let's say 5 or 6 years ago, when India was often referred to as the sweatshop of the world. It's no longer the case. Significant core activities, corporate activities, have been moved to India. And one has to only look at a whole range of Wall Street banks to global business service companies, pharma giants, and so on and so forth. Bringing core innovation-based activities to India, which means that these are difficult to replicate and therefore much more predictable in terms of demand. So even when the pandemic hit in March of this year, as a market observer, my view was that maybe traditional office in the corporate office segment will see some disruptions in the short term, by which I mean over the next 12 months. But other elements of the corporate office segment, such as campuses that are doing a lot of these innovation-based activities, and I dare say in the near future, even things like medical office labs. I think all of these will continue to prosper primarily because of the deep talent pool that the country has. And I think I will just make one more observation. I think a lot has been said about market liquidity. I think that is a big factor for institutional investors to gain in confidence. The advent of the Indian onshore REIT is a material change in the real estate environment, because it creates a deep secondary market, hopefully, as we go along. And it creates a different avenue for capital for real estate developers and operators and managers. And I think it allows investors like ourselves to gain in confidence that we don't have to necessarily look offshore or potentially for just another trade sale to achieve a commercial exit. And I think these are elements that are very heartening. Obviously, this is a story that's continuing to play out. In the short term, I foresee that 2021 is going to be generally difficult because occupiers are going to be tentative. There are going to be, rental renegotiation demands. But I think if you get over that short-term hump, as I would call it, I think we see a significant fairway for India office over the next 5-6 years at least.
So we are in for a long-term positive mode. Ashish, I'll come to you. See, ever since India opened its FDI gates in 2005, office projects have been the mainstay of global institutional investments into Indian real estate. Most of the money that came into Indian real estate came through commercial projects, particularly offices. How do you see this shaping up further in the time to come?
So I agree with that for large part, but with a couple of nuances. If you look closer, you can pretty much divide the FDI sort of period in India into two parts, pre-GFC and post-GFC. Pre-GFC, I would say that most of the FDI, after it was thrown open in 2005, went into really mixed-use projects. So it was a fair bit going into residential, a fair bit going into office. It was after the GFC that in the last decade, roughly, you could say that a lot of that investment has chased office. But there are reasons for that. If you look at what GFC did, it actually created a wall of liquidity and a very large proportion of capital globally, which was sitting at near zero or even in the recent past negative yield territory. And a lot of this capital was gradually coming into the market looking for yield. And from India's standpoint, yes, office sector was also parallelly maturing, like Chanakya pointed out. And hence that has become an asset class that offers yield. And a lot of that investment, a lot of capital has come into India chasing yield in the office sector. More recently, however, the interest in the commercial sector has rather diversified. So now you have a lot of that capital chasing warehousing, for example, and industrial, and also chasing data centers of very late. And largely that is because of factors that Chanakya already highlighted, plus the fact that there is still a lot of global capital out there, which is near zero yield, and indeed some of it in negative yield territory. So that interest, as risk-on sentiment picks up globally and global trade stabilizes in the near future or in the next few years, that trend will only pick up, and there will be more and more capital chasing the yield which can be offered by office sector in India and some other sectors as well. So I expect that trend to continue and gradually pick up over the longer period of time.
Sure, sure. We've seen two successful REITs in India since April 2019 after Embassy Office Parks listing. After a lot of tweaking that took place from SEBI and other regulators and the government side, the latest one, right in the middle of pandemic, Mindspace Business Parks, has witnessed historic response from investors. Vinamra, do you think we are moving in the right direction, and what more could be done to bring in the depth in this segment?
Thanks, Kailash. So moving in the right direction, absolutely, yes, for the reasons that both Chanakya and Ashish mentioned earlier. I think this securitizes the hard assets for investors, provides stable yield with moderate returns over a period of time, brings in a lot of governance and transparency and market research coverage. So if you track the paths of all the mature REIT markets globally, and that's all over from the West, including the US, to the East, in Southeast Asia, Singapore, Australia, Hong Kong, that's the path they all took. So for obvious reasons, I think this is a great step for the Indian market. In terms of going forward and how can this further deepen, I would like to highlight 3 to 4 points, which are more learnings from the path that Singapore took, which I think is one of the nearest benchmarks that India has also used, both from a regulatory setup point of view, as well as how to create the whole ecosystem when the two REITs got listed. The first is we need to move towards a stage where there's much more education to encourage more participation of retail investors. Institutional investors always have much more avenues to participate in real estate, even in a pre-REIT era, even though REIT opens up a bigger funnel for them. But for retail investors, REIT is a game changer because it allows them to really own hard assets which they would have never otherwise owned, which was a purview of only of HNIs in the past. And that is what, let's say, Singapore did. And today, Singapore garners around 25 to 30% participation of the entire market cap just from retail investors, right? And the market has become so mature there that with the $100 billion of market cap they have, it translates to close to around 12 to 13% of the overall stock index, right? So this maturity of the Indian REIT market as we go forward will be a game changer, and a lot needs to be done right from educating retail investors to also managing the return expectations. Because a lot of times retail investors mix up REIT returns with pure equity markets. And REIT is not pure equity, and REIT is not pure debt, right? It's somewhere in between. Just to kind of give you some hard examples and numbers in terms of target returns, the Singapore REIT index has averaged over the last decade around 12% total shareholder returns, dollar, right? And our own REIT, which invests in India, Indus India Trust, has garnered around 18% total shareholder returns over a 5-year period of time. Now, when you compare, when you break this down, around 7% of it comes from dividend yield, right? And in Singapore, the 10-year government bond is around 0.9%. So the spread between a 10-year government bond and the dividend yield from REITs is significant. Now let's look at the India story, right? And India REITs are still very, very new, so it's very hard to really quantify it. But from whatever we are seeing in the prospectus and what we are expecting in the results, the India REIT total shareholder return is expected to be again around 12 to 13%. And if you break it down, the number is similar. It's around 7 to 8% dividend yield, and the rest is capital appreciation. But there is a key difference that all these numbers for India are INR returns, whereas all these numbers from Singapore was SGD returns. And if you factor in depreciation, then you already have to add in a 5% spread at least. So for foreign institutional investors, Singapore still, or I'm using Singapore as a proxy, still provides a lot of attractive return opportunities. So if you want to attract the Indian retail investors, the India 10-year government bond yield is somewhere at around 5.8 to 6%, let's say around 6%, right? And the dividend yield from the Indian REITs in rupee terms is around 8%, let's say, on a higher rate. So the spread is only 2%. Whereas the spread in the mature markets is much more, right? So in order for us to increase retail investors' participation, we will need to ensure that the return profile of the REITs continues to remain robust. And for that to happen, a lot of things have to fall in place. How do you grow scale and improve quality and improve governance will be a key determinant. Because let's not forget, compared to the developed markets, the Indian, and I'm talking about office sector here, it's true for other asset classes as well, the Indian office sector, the availability of tradable income generating assets is not that high in the market, even though there's a lot of capital chasing it. So REITs have to depend a lot on the pipeline of their sponsors. And the development pipeline of the sponsors will face all the risks that Indian development industry faces, right? So the ability to keep scaling, because REITs thrive on scale, and to make dividend accretive acquisitions will really determine how successful the industry becomes, right? And even the focus on governance will become very critical. The REITs that have fallen apart abroad, and these are the lessons we should learn from abroad, were the ones who could not gain scale and who suffered on governance, and investors penalized them heavily for it. So these are the areas where I think there are, of course, 6 to 7 big REITs that we can expect from India over the next few years. But beyond that, how deep can the market go will be a question to really focus. In the very long-term future, how the market will deepen, abroad it has happened through diversification into other asset classes beyond office, as well as even M&As within the REITs. I mean, CapitaLand itself, just we underwent 2 M&As within our own REITs in the past. So this is how in the long term the industry can get further deeper.
Sure. So ITS has continued to thrive through the pandemic-led lockdown, even during this time. This augurs well for Indian office real estate market. And like you said, we've just started, and comparing it like with a market like Singapore, where $100 billion REITs have already come on stock exchanges. We are just beginning. How would you like to shed some light on this? How do you think this entire thing will move from here on? Are we closer to? I mean, how soon we'll reach the maturity in terms of market capitalization and depth here?
I think we should not really focus too much on that, Kailash, because let's remember that those markets took 20 years to reach there, right? The first REIT listed there was way back 20 years back. So I don't think we need to be too caught up right now. We have taken fantastic first steps, and the focus really should be to make sure we get 4 to 5 solid large-scale REITs listed in the market, and that provides much more education to the industry to gain those investments and trust. And really ensure that the pipeline is robust enough to continue to feed into those REITs, and even be willing as a regulator to be flexible. There are aspects of how much development you can undertake, so you can't undertake more than 20%, how much gearing you can maintain, and all of that. And I think we should be flexible and open to adjust as we go along, and that's what the other markets did, to continue to make this as an attractive asset class. And I don't think other asset classes right now are even ready to be able to get listed in the way office is right now, right? So let us focus on deepening the presence in the office sector. And I think it will also, and COVID has probably contributed to that, it will also stabilize valuations in the market. Because once you are under a REIT, you can't really make an acquisition if it is not accretive to your dividend per unit, right? And that provides an inherent check and balance for REITs and owners not to pay exorbitant prices just to gain scale. So this balance of how to grow scale and yet not compromise on DPUs and returns is, I think, a very positive step of maturity in the market. And for the next 4 to 5 years, that's what we should focus on. Really, and to make the portfolio robust, the underlying portfolio robust in the face of COVID. Chanakya highlighted it very clearly that the next couple of years will remain very challenging. In fact, I think the pain seen in commercial real estate may be even slightly more next year than it was this year, because a lot of leases may come for renewal next year. So let's focus on getting the portfolio robust in the next 3 to 4 years, and then we can worry about the long-term future after that.
So,
Kailash, Rajan Bandelkar here. Raj Menda is on me on phone, so you can ask whatever you want to say. Ask Raj Menda.
sure. Mr. Menda, hello, can you hear me?
Yeah, sure, go ahead.
Sure. Will REITs continue to grow in commercial real estate? As a developer, I'm asking you about what do you think? And even other asset classes, do you think the success of office parks REITs will also have a rub-off effect on other assets like retail and hotels?
So, the theme of the need to do a REIT in terms of asset classes, I believe the maximum amount of bundle portfolio world over that can be done apart from office comes actually in residential. But in India, leasing residential gives a very poor return of 2.5% to the investor generally across the board in the country. But the expectation actually only when it crosses a return of in excess of 5% on the capital return can assets get bundled eventually and be put into a REIT. But because in every other asset class, unfortunately in hotels, because of the pandemic now it has gone down quite badly. But I believe when things get normalized, you will find asset classes being made available in all asset classes, and unfortunately the last two bits be residential, because the yields have to slowly notch up to close to 5 to 6% for it to make a meaningful REIT.
Mm-hmm. Sure. So, Ashish, what according to you as a global investor are India's strengths that are helping in attracting capital into Indian commercial real estate? And what more changes one would like to see in terms of regulations? Yeah.
Sure. So I think that investors chase risk-adjusted returns. And if there is capital coming in, and to the extent capital is coming in, it is a function of India's ability to offer risk-adjusted returns in different property types. Some of that will happen in residential, some of that will happen in office, some of that will happen in warehousing and industrial and in data centers, etc., etc. I personally feel that if I take a step back, I feel that a lot of the Indian real estate market's potential is constrained or untapped. And perhaps the potential to attract capital is a lot more than the actual capital that the Indian real estate market attracts. And that brings me to what I would like the government to do in order to realize that potential, or more and more of that potential. Now, if you ask this question, perhaps you will get a different answer from every institutional investor as to what their list of asks or wish list is. But I can say personally for myself, I would like 3 things that the government should do. And these are not incentives. These are things that they should do anyway. The first is I would like a stable currency, because for foreign capital, stable currency goes a long way in reducing the risk perception of global capital. The second thing I would like the government to do is very stable policy. So by stable policy, what I mean is 2 things. Number 1, no back and forth on policies. So bring out clearly well thought policy. And in real estate, that can be often a little bit complex, because real estate is subject of policy at both central government, federal government level and state government level. So this needs a lot of collaboration between the federal government and the state governments to have a stable policy. And the second thing I would like is unification of policy. We seem to have, so, you know, even for a foreign investor, there seem to be many different routes through which they can come in. I don't understand, you know, if I just take a look at, if I just take a step back and take a look at how many different policies are there, these are not very helpful in creating a good perception among global institutional investors. So that's something that I would like to do. And the third thing that I would like the government to do is, I feel that for real estate projects, our approval system is archaic. I think there is a lot of potential in making this as close to single window as possible and making the approval timeframes very predictable. Now that again reduces the risk perception of global private capital, and it will go a long way in ensuring that a lot more capital goes into development of assets than has been going in the past. Indeed, if you look at even office, a large part of the global capital has come into trading of completed assets. It has not gone where the capital is most needed, where the capital will go a long way in meeting the government's objectives of larger multiplier effect on the economy, and where this capital will go a long way also in ensuring that the economy builds up over a period of time. This capital helps build up the economy. Of course, global capital coming into trading of assets is also helpful, but not as helpful as that goes into development.
Sure. So single window clearance, stable currency, and uniform policies reforms is what institutional investors are looking for. While this demand remains in place for long, the industry has so far managed to attract global funds and their interest led by various factors like skilled human capital, cost arbitrage, and growth in the economy. Chanakya, if you were to play the devil's advocate, what are the key things that you would advise Indian commercial real estate developers to avoid to ensure that the momentum of this investment continues in India?
Kailash, I'll respond to your question, but before that, I'd just like to comment on something that Ashish said. The currency aspect, I thought was I'm completely in agreement, because that it creates a lot of unpredictability, and it doesn't make us competitive vis-a-vis other investment opportunities in other investment jurisdictions. But more specifically on government policy, I would say that just have just a little more nuance to what Ashish mentioned. I think over the last 5 or 6 years, I think I would suggest that there's been much more activity in the policy space positively than there has ever been. The very fact that we have RERA today is a pretty significant statement to make. And in a market this size, not having a legislation like RERA until 2016, now when we look back, you just wonder. I mean, that was just probably it couldn't come too soon. Secondly, the fact that we were able to get the REIT regime off the ground. Whilst I understand where Ashish is coming from, that capital is required to build up new stock because we don't have enough new stock of investable grade. I get that. But I think a start has to be made somewhere. So in that sense, I would say kudos to the policymakers to make a start. I think the next untapped opportunity would be affordable housing, affordable rental housing, which I know the government is trying very hard to promote institutional investment into. Now, so I thought I wanted to just add my perspective on that. Now, coming to your question, playing devil's advocate, what I think, I'm I have to be humble. I think the Indian developer community has made huge progress over the last decade or more. They've done a lot of work in a very difficult environment that is federal in nature, where land is a state subject. It's easier said than done to say that approvals should be more streamlined. And I really feel for this community, because we all expect to earn off their backs as investors, but the operating environment is not as hospitable as we think it is. So having said that, I think if they really want more perennial streams of global institutional capital, and the operative word is perennial, and it could be perennial because the market is large, I think they need to really self-embrace, I would say, a genuine ESG culture. Not manage optics by getting some green certification before you go for a listing or things of that nature. That's great. I'm not saying that it shouldn't be done for the right reasons. All I'm saying is, today, if you look at India and through the eyes of an international institutional investor, the glass is half full, in the sense that things have improved, but it's still seen as a very, at best, a translucent and a complex market. And that complexity, whilst a large part of it is at the policy level or the regulatory level, which will get better as it has over the last 2 decades, I think at the operator level, if there is a genuine acceptance to propagating and actually self-following a culture of governance, genuine social engagement, and genuine environmental sensitivity, I think there is a lot of capital that could flow into this country. One only has to look eastwards to the amount of capital that has gone into East Asia, into China. And I think that the reason is very simple. The reason is, operators have walked the talk, like Indian operators or developers are doing presently. I think I would say that over the last 5 years, one has seen a huge change in attitude and willingness to adopt and embrace global best practices. And I think what I'm only saying is that needs to happen even faster, and without much goading or coaxing. Hope that makes sense.
Sure.
Kailash, I just want to take a few seconds here. I would like to remind our attendees to type their questions in the chat box for our moderators to take it up with the speakers, time permitting. Thank you, Kailash.
Thanks, Niti. Mr. Menda, do you think the pandemic forced work from home model is giving rise to a different kind of hybrid model? Because some companies are allowing, most of the companies have allowed their employees to work from home, say, until summer of 21. And so some of them will be reporting to office, some of them will work from home. That gives rise to a hybrid sort of model. And how would developers like you prepare themselves and their offerings to face the situation like this? What sort of impact this will have on demand for offices and also the investment appetite among institutional investors?
So, the point is, safety is obviously, safety and well-being is obviously a prime concern for all clients who have occupying the offices. All the large multinationals, obviously, for keeping the safety of all its employees, are encouraging them to work from home, knowing fully well that it really doesn't give that high quality output, because 100% of all our clients, I'm talking of the large multinationals who are my customers, are choosing to stay in these large grade A offices and not vacate any space, because they know that post March or April, when the vaccine is successfully administered, people can get back to the offices to work. because that's the only way where you can work the collaborative way. But in the short term, your question is how does this hybrid situation come about? There's a lot of concept of people occupying. We also have co-works as our brand, where they are occupying spaces in our co-working spaces in a satellite form fashion, so that people, whenever you need to meet in small groups, you can meet in a remote place, not necessarily travel the entire distance to work. And meet in the satellite offices, and so this concept of working satellite and not necessarily taking a flight and working in that fashion, I think works the best. But I believe that since all the clients who have currently occupied large spaces, and there's a shortage of Grade A spaces in the top 6 cities which operate and have been occupied by all these large multinationals. This will continue, and there's a growth. This is still visible. And I do find that the amount of new leasing that has happened in the COVID period also is a clear indication that the absorption is going to continue, because the only availability of English-speaking, English-thinking technical manpower is available in abundance in India, and that is going to help this country to get back on its tracks. And they'll have to get back to the office to work in teams and groups to get the efficiency improved. Thanks.
Sure. Vinamra, at CapitaLand, are you expecting a change in occupiers' expectations from the developer and operator post this pandemic? And how important do you think that these new buzzwords that Mr. Menda also mentioned, well-being and sustainability, be in the future developments from here?
Yeah, I think Chanakya and Raj alluded to it, and in my view, they are no longer buzzwords. The Indian market is rightly so catching up on ESG, not just as a marketing slogan, but in the way they run their business. And I genuinely feel that's the only way they can sustain the interest of foreign capital and foreign institutional investors in the long run. So whether it is about sustainability through energy sources, increasingly portfolios are becoming greener in terms of where they source their energy from. For us, for example, 30% of our India portfolio runs on solar power, and it will go up to 50% next year. To about how do you get operational efficiencies of reducing your energy and water intensity on a per square feet basis, and that is where the usage of IoT and artificial intelligence and predictive data analysis comes into picture. To how do you manage waste and recycle waste in your parks, because the kind of parks that institutional players operate are quite huge, and all of these tailor to ultimately your contribution to emission reduction, and then balancing that with even sourcing green financing. I mean, we recently announced 17 crores of green financing in India. Globally, our target is to go to 6 billion of green financing over the next few years, right? So I think not only the expectations of occupiers, but also of investors and the markets towards the Indian portfolio and developers to focus really on ESG, not just from the perspective of achieving certain ratings and certifications, but really getting it ingrained in the way they build and operate the portfolio is going to be immense. And this will only keep getting more and more mature. For example, now we're at a stage where we're even tracking the construction waste efficiency. So far, it was only on the operation side. Now it's also while you're constructing, how much waste are you generating, how are you disposing it, and how efficient you are. So I think there's a long way to go, but we are on the right track. And the same holds true for wellness as well. COVID has only accelerated that trend, thankfully, but that trend was underway. And some of the top players in the industry were already focusing on the wellness of their developments from the point of view of ensuring health and safety, and going really deep down to not just having a nice green landscape, but in terms of the kind of materials to be used, the air quality, the water consumption, ambient temperature, and so on and so forth. So the expectation of occupiers is getting more nuanced. They are getting more sophisticated. All the big Fortune 500s have a substantial presence in India, and they would always compare the experience that their employees need to have with what they're having in Silicon Valley or in East Asia or in other developed markets. And there's no reason why their Indian employees should not have the same kind of experience. So the onus really comes on the developers and the operators to be able to provide that experience both through sustainability, through digitalization, and through wellness. So I think this is an area which not only has a huge potential going forward, but it will also be a key differentiator between the kind of institution developers and operators who can meet these requirements of customers and those who cannot.
Next year, what do you think, all of you, would be the outlook for investments into commercial real estate, particularly offices and new areas like data centers and logistics?
I think I can only talk for ourselves. Our high conviction themes, notwithstanding COVID, no COVID, I think for the last couple of years and perhaps for the next couple as well, is office and logistics. Those are the two high conviction themes for obvious reasons. We've already talked about why office. I think India is on the cusp of a digital super cycle. I'm absolutely convinced. And in that kind of environment, we think that logistics is going to be a major disproportionate beneficiary to what's going on. And in that context, I think data centers, for a variety of similar but different reasons, also different reasons, not least the localization of data, the proliferation of big data, etc. I think is going to mean that that's another sub-asset class under storage, so to speak, is going to be pretty much the focus of institutional investors. I don't understand too much about data centers. I'm not sure even whether it's private equity or infrastructure. It's probably least of all real estate, because that's only the box. So we are still figuring it out, but nonetheless, I think there's lots to look forward to. Thank you.
Yeah, just to add on from CapitaLand's perspective, concur with Chanakya, our focus investment themes will remain office, logistics, and data centers. We are already quite big in office. In logistics, we're already the second largest right now in the country. And we have already launched our data center platform, and we are close to completing our first investment there. So these will remain the big themes. And COVID has not changed our 5-year long-term investment thesis in India. And India is not for the faint-hearted. We've been here for 25 years, seen a lot of ups and downs. You've got to have the flexibility to calibrate. But if you believe in the underlying demand drivers, you need to stick through. And that's how we see our love affair with India. And we will continue to deepen our presence in all these sectors and increase our share in the new gen sectors that we just talked about. So we remain very bullish, but at the same time cautious in the short run of the next 1 to 2 years, given the COVID impact.
My take would be that it is very property type specific, and I would say from infancy to, I would say, early maturity. And early maturity would be really office sector. Infancy would be stuff like warehousing and data centers.
I would just say resilience. This is the time to show resilience, irrespective of. Yeah, for me, it will be resilience. Irrespective of the asset class, this is the time to show resilience and gain confidence of investors.
Thank you so much, Kailash, for ably moderating this session. And my sincere thanks to all of you, Ashish, Chan, Vinamra. It was really unfortunate Raj could not join us, but thanks to Mr. Bandalkar, who always comes up with these out-of-box solutions, and got him on a WhatsApp call, and we were able to have Raj join us. And I do believe that investors are gung-ho about India's growth story. And thank you all for sharing your perspectives. I would like to now get on to my next session. We have with us Dr. Ajit Ranade. So honored to invite you, sir, as our next session speaker. Dr. Ajit Ranade is the Group Executive President and Chief Economist with the Aditya Birla Group. And he would be delivering a keynote session on India. And speaking from an economist perspective, he's a distinguished person and has been consulted by many apex bodies and committees. He chairs the research advisory panel of the Indian Institute of Banking and Finance and is a governing council member of the Research Institute of the Apex Bank, the Reserve Bank of India. He's a columnist with Mumbai Mirror, writes for many other leading publications, and has authored several books. Dr. Ranade, we really look forward to you sharing your perspectives and the opportunities that India has to offer. Over to you, sir.
Thank you. Thank you very much for those very kind words of introduction, Ms. Neetu. Very good morning to all of you, and thank you for inviting me to this very great, big and important conference. So I'm here to share my thoughts about the macroeconomy and its relevance to the theme of real estate, infrastructure, housing. We are in the middle of a pandemic, as you know, and there is still a lot of uncertainty about the road ahead or the road out of the pandemic. But that's not to imply that actually a lot of developments on the health, hygiene, science, vaccine part of it are happening. So my topic, of course, is not going to cover that. But if you've been following the news about the COVID research, you'll see some of that bullishness or optimism reflected in the stock market. Of course, sometimes the stock market gets carried away, and sometimes it's ahead of itself. But you can see globally, not just in India, globally, the stock markets are at an all-time high. I should, of course, caution you that not all of it is coming out of the vaccine optimism. Not all of it is coming out of, let's say, the optimism about the revival of economies around the world. Some of it is, unfortunately, also affected by the fact that monetary policy around the world, that is central banks, have been extremely accommodative, have been extremely supportive, so much so that the liquidity support, whether it's in terms of money supply or credit availability or subsidized loans or very low interest rates, all that has caused a huge amount of liquidity to come into the system, into the economy. And some of it is finding its way into the stock market and asset markets. So some of the valuation or some of the rise in stock prices is coming because of that. So that also is a factor one needs to keep in mind. It has also gone into areas like commodity markets. So base metals like copper, aluminum, zinc, they're all traded on commodity exchanges like the London Metal Exchange. So that exchange, that price discovery is not only related to the ultimate demand for these metals, but it's also related to the demand from speculators or from investors who just want to hold it as you hold, say, gold or precious metals. So some of those prices are also racing towards all-time highs. So that's just the macro background. So the macro background is that the global economy responded very strongly to the pandemic-induced effect on the economy, that is the recession. For the first time after a very, very long time, the entire global economy has shrinkage. So the global economy is expected to, this year's GDP, the calendar year 2020, is going to be about 4 or 5% less than last year's, and next year we bounce back. And most of the economies, except for China, and China is the second largest economy in the world, except for China and maybe a couple of others, everyone else is going to experience a contraction. So when it comes to India, we expect something like a 6-7% contraction. So last year's GDP in real terms, inflation-adjusted terms, was 200 trillion rupees. This year may turn out to be about 190 trillion. That is our fiscal year 2021, April to March. And next year, we expect again a bump up again by another 10%, 10%. So as I said, some of that optimism is already reflected in our own stock markets. That's as far as the global pandemic and reaction to the pandemic. But let's step back, because this is, the theme of the conference is on a topic like, say, real estate or housing, infrastructure, and so on. These are not things which change from month to month, quarter to quarter, or even, I would say, year to year. We have to take a somewhat longer-term view. So I want to dwell on longer-term macro determinants, or what I call macro trends. The pandemic, the COVID situation sometimes gets us bogged down in short-term, in looking at the short term. But just stepping back, let's look at the longer-term perspective. I also, by the way, fundamentally, I also believe that our preparedness in handling the pandemic or COVID is hugely better than all previous episodes. There's a global community working together. There's huge connectivity and sharing of knowledge and science. The way the genomics and the mathematical biology works, you can actually the vaccine can be actually put together in hardly 15 days. The time taken is mostly in terms of the approvals and the testing and the FDA and so on. So this capability in the world today is very different from what it was in the past. But let me talk about the macro trends. And these are trends which are fairly, I think, definitive and much less uncertain, much less, much less. What should I say? There is certainty about it. Number one is demography. Obviously, you know that India's demography is such that the average age of India is about 28 years, 27, 28 years. So if you in the audience are above 28 or 29, you're in the older half of the country. And this is going to remain for the next several decades, 2-3 decades. What this means is that the workforce expands, India's demography, the implication is that the workforce is expanding a full 1 percentage point faster than the population of India. So maybe the population is growing at around 1.2, 1.3%. The workforce is expanding at 2.4, 2.5. What this means is the class of the workforce or the class of the population, which is maybe learning in school or in training, which is going to be earning, which is going to be consuming, which is going to be investing, which is hopefully going to be paying taxes, both direct or indirect, is expanding. That's a virtuous cycle. So India will add such people, 250 million such people in the next 30 or 40 years. That the implication for the economy is huge. Just by comparison, the other large country in the world by population, which is China, which actually in the next 30, 40 years will be decreasing because they have already reached their aging peak and they will be decreasing 150 million people from their workforce. That's the power of demography. You heard this many times before, but it's worth reiterating. So that's point number one. Additionally, by the way, in demography is that our female participation in the workforce will also increase. Just yesterday or a couple of days ago, the state government of Odisha announced that they will be allowing women to work in third shifts, women workers to be working third shifts. Similar measures have been taken in states like Karnataka. What that means is that, especially in sectors like textiles, garments, retail, workforce participation from women will also increase. It's quite low actually in India. It's only about 20-22%, and we need to go at least to 30-32%. So all this workforce participation has implications for demography, has implications for consumer demand for housing, and so on. Number two is the shifting of economic center of gravity from west to east. So India is part of eastern part of the world. The higher growth rates are going to be seen in this part of the world, including India in East Asia. It also has it is coming from what we call infrastructure spend or urbanization. India is going to see one of the most rapid pace of urbanization. We are about 31-32% right now. The world as a whole crossed a major landmark in 2015, 5 years ago, where more than half of the world's population, that is 50% or more, is now living in urban areas. Of course, that includes the Western world also. In China, also, urbanization has reached 60-65%. In India, we are at 32%. So that's my second mega trend of urbanization. That again has implications for housing, commercial real estate, urban infrastructure. Third is digital, the trend towards digital and automation. This, if you take the digital metrics, India is actually leading the world. The electronic identity, the Aadhaar identity, which was given to 1.2 billion people. The most rapid increase in internet users and smartphone users. I think something like we're going to reach some 400-500 million. Just one metric, if I can mention, the UPI users. the people at the retail level, those who make payments, retail payments as small as 50 rupees, 100 rupees, using UPI, mobile to mobile payments. UPI user transactions reached 2 billion last month in October. 2 billion. This explode. The next 5 years, we're going to see all metrics related to the digital economy, whether it's from digital payments, whether it's from digital transactions, whether it's from automation or use of IoT, Internet of Things, it's going to explode. In fact, I think that the contribution of digital economy to the overall economy could reach $1 trillion, could reach 20-25% or higher. So that's another big trend we need to be aware of. Number 3 is infrastructure. Now, of course, this is well known to this audience. Sorry, number 4. So first is demography changes. Second is urbanization and the shift towards growth, the growth happening in this part of the world. Third is the digital revolution. Fourth is infrastructure, which again, you know about this. We have the National Infrastructure Pipeline, which was announced, and a fair amount of details given back in December. We expect merely in construction alone. I have seen a CRISIL report which says that in the next 5 years, you're going to see about 46, 47 or 50 trillion rupees. 50 trillion rupees, which is almost about that would be about $900 billion of spending on construction. And the construction includes, by the way, infrastructure as well as residential and commercial real estate. This is a huge number. And about half of it, or 60%, will be on infrastructure. About remaining will be on commercial and residential real estate. And the last point I want to mention, so let me just repeat the 5 mega trends I've mentioned. Demographic trends, the urbanization trend, the digital economy automation trend, the infrastructure pipeline infrastructure spending, including construction and real estate and in commercial and residential real estate. And the 5th point is about climate change. This is a mega trend, not just for India, for all over the world. So increasing emphasis on whether it's economic activity or building or on paying attention to climate change issues. So whether it's I think in the earlier panel, you heard somebody mentioning about the fact that we are aiming for 100 gigawatts of solar power. Our ambition for renewable energy is among the highest in the world. That has implications for what kind of economic activity we'll see. That has implications for what kind of industrial activity we'll see, what kind of compliance will be required, what kind of sustainable industrial growth we need to be prepared for. So I'll just leave it at that, climate change. So when you take these 5 mega trends and then look at what implication does it have for the sector that we have here under discussion. So you know that if I look at demography, as I said, the workforce increased from whatever it is today, which is about 400 million, to another 250 million. And if you have women's participation, even more. So what kind of trends are we going to see? We are, of course, going to see the increasing trend of nuclear families, increasing trend towards, let's say, townships or rental housing. That's on the residential side. On the working side, on the commercial real estate, we will see perhaps demand for flexible working spaces. We are going to be, the digital means we are going to see trends of work from home, working from home. The one big contribution of the pandemic has been the fact that people have got used or have got somewhat comfortable about the digital domain. The very fact that I'm participating in this conference, we are digital, sort of in the digital mode, itself shows that how this has got a big thrust. So that has implications for how workers will work. Maybe there'll be more of working from home. There's of course going to be much more use of technology, safety, hygiene. So this is all. This is the implication for construction or real estate, residential and commercial. The other thing I would say is the reforms that are going on, and some of them have been mentioned. We have seen in terms of regulator, we have seen brand new regulator which came into being, I think, last year, RERA, and it's fine tuning it. It's already seen huge, it got a big impetus for the organized players. So we're going to see the transition from unorganized to organized. But I must say that the economic reforms are such that they are responsive. They respond. It's some of it is trial and error. I mean, for example, in the state of Maharashtra, because the current situation demands it, we saw a reduction in stamp duty from 5% to 2% in the city of Mumbai, and the rest of Maharashtra is 3%. So that is a responsive policy. As the situation demands. Same thing. I'm sure there was some concern that the money that's locked up has to be released. So I think there's already been some modification where, as a proportionate, commensurate to the percentage of completion of work, the money which is locked up in escrows and all will be released. That's one thing. Second is the other reform is on the REIT, the real estate investment trusts. That's a financial sector reform, but that again has implications for this sector. So that is that's another second example of reform. Third example is from the infrastructure space. As you know, whether it's roadway building, highways, we have adopted the hybrid annuity scheme. So for some time we got stuck in perhaps litigation between in the PPP mode. So we have shifted. So that this is an example again where the policy response has been such to unclog those difficulties. Hybrid annuity scheme. So I think we are going to continuously see these kind of responses. Even the National Infrastructure Pipeline, which was launched in December, envisages the total amount for 5 years. Envisaged was 100 something like 110 trillion rupees. But that's going to be made up of 70-30. 70% is going to be from private sector, and even in funding, it's going to be a combination of debt and equity. And this is an example where the long-term, the infrastructure spending requires long-term funds, and we will, I think, we'll see the marriage of long-term funding requirement with long-term investment, so resources such as sovereign wealth funds or pension funds of the West. So this is an example where there is a coincidence of the need, of demand and supply. The demand is coming from long gestation infrastructure or housing projects, and the supply is coming from financial sector reforms, which through schemes like REIT, which enable this money to come into India. Incidentally, there is also this aging. I mentioned the demography means that the aging population is in the West, so pension money is in the West, but the requirement for long-term funding for long gestation projects in India. So this marriage also is an example where we are going to see these trends. So I think, let me say that whichever metric you look at, the infrastructure deficit, which requires huge spending and investment, the housing deficit, which requires the building of some 28 or 30 million new residential affordable units, the shift towards townships, the shift towards rental housing, the shift towards climate change, compliant infrastructure and housing. All this just gives you a fairly optimistic view. And the fact that hopefully policy and reforms and economic reforms will be responsive to these trends gives us, there is tremendous optimism on this front. So I will of course conclude by saying some of the comments which came earlier, that we need policy stability, policy continuity and predictability. We need a stable exchange rate, and we need a regulatory approach which is responsive and conducive for economic growth. All that goes without saying. But I just gave you some macro and mega trend indicators which feed into that. So maybe I'll stop here and then come back to any.
Thank you so much, Dr. Ranade. Really appreciate your insights. It was an eye-opener that India is leading in digitization. Was not really aware of that. Thank you for sharing that, and how infra spending will contribute to 60% of the spend. And we do agree that sustainability will continue to underpin whatever we do within the industry.